Hello and welcome to the latest Charter Hall Direct Quarterly Update. Strong demand for long-leased Australian commercial property drove valuation growth and increased demand over the June 2021 quarter. Pleasingly, our direct funds have continued to perform well, with outperformance ranging from 1.2% to 25%. Notwithstanding the current impact from lockdowns, Australia has experienced a broad bounce back in the economy, with a combination of favourable fiscal and monetary policy settings, record prices for Australian commodities led by agriculture, and an unexpected level of employment growth. This has resulted in an increased level of consumer confidence and retail spending. One of the transactional highlights during the quarter was the sale of what has become known as the Milestone Logistics portfolio for a record $4 billion. This was sold by Blackstone Group and was acquired by ESR, a group from Asia that has been increasingly building a presence in Australia and specifically in the fast-growing industrial and logistics sector. This was a major transaction for many reasons, as it resulted in a repricing of the industrial and logistics market. For Charter Hall, it was business as usual. We continued to build out our allocation to the sector with specific investments, mainly in off-market transactions that traded at more favourable valuations. Prior to the recent outbreak of COVID-19 and restrictions tightening across the country, it was pleasing to see a steady return of people coming back into our cities and offices. For the office market, our tenant customers and their staff, we were beginning to see a balance between working from home and the office. This resulted in a more flexible working environment. As the rollout of the vaccine gathers pace around the country, we continue to hold the view that the signs for Australian commercial property remain positive. I hope you enjoy Stephen's update and look forward to speaking to you again soon.
Thank you for joining us for an update on the Charter Hall Direct Suite of Funds performance at the end of the June 21 quarter. I'm Steve Bennett and I head up the direct business at Charter Hall. The direct business is part of the wider Charter Hall Group, which has grown to become one of Australia's leading fully integrated property investment and funds management groups. We have over 1,400 assets and $52 billion in funds under management. Now let's begin the presentation. So in terms of formalities, I always like to remind you, and you can see up there on the screen, that we're not able to provide financial advice. Today's information is an update and an education process, and should you require further information, we do encourage you to speak to a financial advisor, read the offer documents in full, or to contact the Charter Hall team. Today's agenda will cover off three broad themes. The first being an update on the wider Charter Hall Group. The second, I'll give a bit more detailed information on how the valuation process works for unlisted funds and the direct property market. And finally, I'll wrap up today with more specific information on some of the funds, as well as a sector update on the office and the industrial markets. So in terms of Charter Hall, as at 30 June, we had $52 billion of funds under management. And as I just said, 1,400 properties. And you can see there that the group has grown at a strong compound rate of 27.5% per annum over the last 5 years. I say this not to boast at the size of the group, but with property, size and scale is a real benefit. It means we've got deeper and more relationships in with our tenant customers. It means we get shown acquisition opportunities that others in the market don't see. And it means we've got more negotiating and bargaining power with key debt providers in the market. This next slide shows the fund performance since inception of each of the direct suite of funds. The blue bar represents what each fund has delivered on a per annum basis since they were first launched, and the grey bar, the relevant benchmark, also at the time of their launch. It isn't an accident that we show the since inception return. We're not showing you here the quarterly or even 6-monthly or 12-monthly return, and that's because we always tell people that property, whether in unlisted form or listed, should be a medium to long-term investment. But what this graph does clearly show is over the medium to long term, all our funds have not only provided some fantastic results for our investors, but they've also exceeded materially the benchmarks. The next slide up on the screen gives a little bit more colour on the return and the performance of our Maxim Property Securities Fund. The Maxim Fund is different to the other unlisted funds because it invests into stocks and securities that are listed on the ASX. It means it's a liquid investment, but it does come typically with a little bit more volatility than unlisted property. Importantly though, it's outperformed across all periods and the purple line showing the maximum return versus the grey bar, which is the benchmark return. The graph on the right shows how $10,000 invested into Maxim 5 years ago has grown compared to $10,000 invested into the benchmark index. I often get asked about ETFs versus active management, and what this graph does show that the active management of the Maxim team on an after fees basis has significantly outperformed the benchmark or what a typical property securities fund ETF would have provided. So why do people invest into unlisted and listed property securities? Well, obviously they want the regular and growing income streams, but it's also important to look at the capital growth of the underlying investments. You can see here that all our funds have unit prices in excess of the dollar per unit. One of the key drivers you'll note on the screen is that there is some variance in how far some have grown versus others, but the biggest driver of that is typically how long the fund has been around for. Some of these funds have been in existence for over 10 years, meaning that they've had longer to get that compounded capital growth, whereas other funds have been launched as little as over 2 or 3 years ago. But pleasingly, all our funds as at 30 June had valuation increases, meaning that not only did investors get regular and stable income across the last 12 months, but they also benefited from capital growth. As I said at the start of today's event, I'd be providing some more information on how the valuation process works in relation to direct property. Importantly, for our open funds, they are funds that are open for investment at any point in time. We get properties valued every 6 months. The valuations are done by independent firms, so that is groups outside of Charter Hall. Typically, the valuations are done at 30 June or 31 December, but we will get valuations at any time where the management team or the RE board believes that the valuations have moved materially. For the fixed life funds, so that are funds that aren't open for investment, they will typically have valuations every 12 months. But like the open funds, they're independent valuations by top tier valuation firms. What I would also add that the valuation techniques differ. By that, I mean the independent valuers will use a number of methodologies to make sure that they're comfortable with the valuations that they provide to us. They'll be a combination of DCF, so discounted cash flow model, the capitalization rate approach, as well as comparable sales. Valuers always look at what's happening in the real market. They want to check that the valuations they're ascribing to assets match up with transactions that are happening on arm's length terms, and this occurs across the various sectors regardless of whether it's office, industrial or retail. So across the group, as part of this valuation process, which we just completed at 30 June, it's probably worthwhile sharing some of the highlights and insights. Of the 1,400 assets, 1,200 were independently valued. There's some key themes that became pretty obvious. The first was that long WALE properties have provided typically valuation uplift. In a world of low interest rates, low term deposit rates, there is still a large volume of demand for assets that provide regular long-term income streams secured by quality real estate and strong tenant financial covenants. This is part of the reason why the Charter Hall suite of funds benefited over the last 12 months. This long leased approach and security of income is what the group focuses on, including the direct suite of funds. For the office assets, there was 2 distinct themes. The best quality assets, the ones that had low vacancy rates, long-term leases, they also benefited from valuation uplifts at 30 June. However, if an office asset entered the pandemic with high levels of vacancy, short-term leases, or was in a secondary or off-pitch location, these are the assets that came under valuation pressure. Once I get to explaining the returns of our office funds in DOF and PFA, you'll see that they both had valuation increases. And finally, what I would say is, despite these increases, we are remaining disciplined. We are keeping all the funds gearing below 40%, and we have continued to sell assets where we believe that the risk-return benefit to investors has been maximised. So that's a trend you should expect to see more of in the next 12 months, particularly in the open funds, where we're continually trying to upgrade the portfolio quality by selling assets as the funds grow. This is the part of the presentation where I'll provide more detail on some of the funds in the direct suite of products. The first being the Maxim Property Securities Fund. It delivered over 36% per annum return over the last 12 months. But as you'd expect me to say, people shouldn't come into the fund expecting those levels of returns. The fund has benefited by being able to take overweight positions in a number of stocks. This is something that passive or ETF, exchange traded funds, simply cannot do. And as you saw at the graph at the start of the presentation, the $10,000 invested into Maxim on an after fees basis has significantly outperformed the benchmark. The underlying stocks that Maxim invested into still look like they screen well, particularly when you compare it to the general equities market and the long-term bond or 10-year debt rate. The next fund which I'll talk about is the Charter Hall Direct Long WALE Fund, or LWF for short. LWF made a number of accretive and high-quality acquisitions during the quarter, and there's an acquisition which we're currently in due diligence for, which I look forward to being able to provide an update on at the 30 September period. Importantly, the fund maintains a 100% occupancy and over the last 12 months delivered a 17.1% return to investors in the fund. This fund, unlike some of the other direct suite of funds, provides distributions to investors on a monthly basis. And as you can see on the right-hand side, it benefits from some very strong tenant covenants, being Bunnings and Coles to name just a few. The LWF benefits from being a diversified fund, meaning that investors get exposure to not just a particular subsector of the commercial real estate market, but a number of them. The right-hand graph shows that how the asset composition was split across these sectors as at 30 June 21. The next two funds which I'll talk about are invested into the Australian office market. However, before I get into the fund specifics, I thought it was worthwhile providing an update on the office market. I get lots of questions around this because of the pandemic and working from home. What the graph on the screen shows that if you look at the differential of core Australian office markets versus global markets, they look quite attractive. The graph shows for the Australian markets, which are the brownish colour, and the offshore markets being the blue, the spread between the capitalisation rate and the cost of long-term debt. The bigger the gap, meaning the more buffer you have between the income you can receive on property versus your cost of funding. This next chart, which you'll see up on the screen, shows the net absorption of the office markets throughout Australia. Net absorption is just a fancy way of saying the total net demand, so the new leases less whatever space has been given up or relinquished. You can see there a trend where the level of net absorption declined. This is an outcome you'd typically expect in any economic correction, whether pandemic driven or from another reason. But pleasingly, what you can see there is a definite turning in this trend, meaning the negative absorption is coming off the low and things are starting to look up. Obviously, we've had some recent lockdowns, which will slow that down again. But once you have open borders, more immigration, the continued economic rebound and economic growth, this will typically lead to further white-collar employment growth. White-collar employment growth is an indicator of demand for office space. So whilst this graph isn't trying to predict the future, it does show you how things have moved through different cycles. So what other trends are we seeing in the office market? Well, the trend that's been happening for the last 3 decades around office densification, that is getting more and more office workers in a given amount of space in an office property, is beginning to stall and potentially may even reverse. As you'd expect, the pandemic has made people more conscious of the space and making sure that you've got adequate room to move around. The picture on the left of the screen shows a typical office before the pandemic, lots of people in very close proximity. What you're now typically seeing is tenants being more aware and looking to space out the people, more collaboration areas, as well as more breakout areas and amenity, including the provision of food and beverages within the office complex. Another trend which we expect to play out more so over the medium term is the flight to quality. This is from both a tenant or occupier perspective, as well as a purchaser or an investment perspective. So what happens when the market is a little bit soft is that tenants become more discerning on the kind of space they want. We believe that the prime end of the market, so the highest quality property, the properties that have more room to move, greater amenity, have focused on the hygiene and some of the touchless entry points, as well as the end of trip facilities that tenants now expect, will continue to be in demand. If, however, you're in secondary assets, properties with low levels of light, without any amenity, then we believe it will be more and more challenging to lease up these, and ultimately that will flow through to the valuation of these assets. So now, moving on to our first office fund, the PFA fund. It is now a $2.1 billion fund that is diversified across both tenants and geographic region. 58% of the income is provided by federal or state government entities, and they are the highest quality, most secure tenants you can hope to achieve. The fund return over the last 12 months was pleasingly 12.1%, and the fund continues to pay distributions on a monthly basis. It has a high level of occupancy, as well as a long weighted average lease term of over 7 years. And I've just gone through some of the key statistics on the PFA fund, but because we're talking about property, I never miss an opportunity to provide a video because I think that's the best way to illustrate the types of assets. What you'll see up shortly is a video of the PFA Westmead asset. It's a new property currently under construction that's already secured some top shelf tenants in Western Sydney University, the CSIRO, and the other space that's available is currently in active negotiations and just subject to final leases. The reason why we like new properties is because they benefit from low capital expenditure, and also the tenants are typically sticky. If you sign up a tenant for the first time in a brand new building, more often than not they extend once they hit their long-term lease expiry. So now I'll show you this short video.
The investment in Westmead is extraordinary. It includes a $5.8 billion investment in the precinct itself. That's in the hospital expansion and redevelopment. We have the University of Sydney developing, and importantly, IQ, the partnership between Charter Hall and Western Sydney University to create a world-class precinct.
IQ Westmead brings together health, research, science, education to collaborate, innovate, solving some of the great global challenges we're facing.
Coupled with proximity to Parramatta, emerging light rail connectivity, when Metro goes all the way through Parramatta from the city, Westmead will have great transport connectivity.
You're going to see an infrastructure transformational change to this precinct that is both commercially viable but is also giving back to the community.
Western Sydney University will be on site in partnership with innovative companies and businesses interested in the health and well-being of our nation to create the research critical mass to drive the innovation precinct into the future.
The basic and applied research that happens at Western Sydney University will come of age at IQ. We've got opportunities there to be working with communities, with clinicians and health workers, with researchers from across the globe.
It's designed around a village square concept to provide collaboration, retail amenity, and a central focus point for the occupants, whether they're workers in the various corporate and non-corporate organisations that we think will fill up the whole 40,000 square metre campus. Health and hygiene has always been at the forefront of the way we've designed our buildings, and importantly, the whole engineering within the building becomes symbiotic with that vision. Innovations around electric cars and battery charging and touchless technology, it's something that we see as the future in a precinct like Westmead.
The facilities at IQ are going to be state-of-the-art. We're very excited to be in a precinct that brings together some of the most brilliant minds in Sydney and beyond.
This is a unique opportunity. It's regenerating Westmead. Its proximity to Parramatta is crucial. I suspect it's one of the most important regeneration projects underway in the world at the moment.
The final office fund which I'll update you on today is the Direct Office Fund, or DOF for short. It's a very large $2.7 billion fund. It achieves over a 16% per annum return over the 12 months to 30 June and benefits from a very strong list of tenants. In fact, the largest group of tenants are federal and state government, representing over 38% of the income. This fund pays distributions on a quarterly basis and pleasingly has benefited from the continued strong investor demand in the core markets of the Sydney and Melbourne office sector. Moving on to the industrial market and our first fund in this space, the Charter Hall Direct Industrial Fund number 4 or DIF4. Being the industrial sector, the assets are typically smaller dollar value than the office sector. So you can see here the top 10 tenants on the right hand side means that you've got a lot of diversification across the tenant spread as well as some terrific entities. The benefit of the industrial and logistics sector is tenants typically are willing to sign longer term leases than in some of the other sectors. The fund weighted average lease expiry or WALE at 11.2 years is one of the longest in the entire suite of funds. This fund pays distributions on a quarterly basis and also benefited from some significant property revaluations at 30 June, leading to a great 12-month performance. So what are some of the trends that are driving the industrial and logistics market, not just in Australia, but in a global sense? Well, there's three broad trends. The first being around e-commerce, where people are continually buying more and more of their purchases through an online format. This drives demand for increased amount of warehouse and logistics properties. The second is around just-in-case inventory control systems. So what the pandemic has shown is that there can be some significant disruptions to supply chain. And it may make sense, and for many tenants it does, to hold more stock so that you're not caught. By holding more stock, a tenant needs to take more space in the industrial market. And finally, there's a trend around onshoring. This is a reversal of the trend of offshoring, which had been playing out prior to the pandemic. Governments and corporates have realised the benefit of having domestic capability in things such as PPE, food, medicines, and even vaccine production. So we expect over the medium term to see greater demand for manufacturing space as well as warehouse and logistics off the back of this. And the slide you can see up on the screen shows the tenant demand in the industrial space broken down by the relevant markets throughout Australia. Over the last few years, we've been above the 10-year average of space that's been let. And even the current year, we're almost past the 10-year average and we're only approximately halfway through the period. This greater demand for the use of industrial and logistics space from tenants will ultimately flow through to higher rents that landlords such as Charter Hall are able to achieve from these properties. What I'll show shortly on the screen is DIF4's most recent acquisition, being a new industrial warehouse leased on a long-term basis to DHL. DHL has over 400,000 employees, operates in 220 countries, and is a fantastic financial backed company. This is exactly the type of tenants which we like to target for our industrial and logistics portfolio. So I'll now show you this short clip. The final fund which I'll talk about today is the Charter Hall Wholesale Property Series number 1, or WPS1. It is available only to wholesale and sophisticated investors, and it does have a minimum investment amount of $250,000. It has a slightly longer investment term of around 7 years remaining, and it is invested across all the core sectors and invests in some of Charter Hall's best ideas. It's had a fantastic return over the last 12 months of 20%, and it is our most recently launched fund. And I can't wrap up today's quarterly update without running through some of the fund's most recent acquisitions. Up there on the screen, you'll see 4 of the most recent purchases by our open suite of funds. I won't go through them in detail, you can look at them in your own time, but there are some common themes there. They're high quality assets, typically with 100% occupancy rates and very strong tenant governance. The industrial fund, DIF4, was also active during the quarter, making a number of acquisitions. It picked up a long leased asset in the highly contested and tightly held South Sydney industrial and logistics market, as well as picking up a property in Tamworth leased to Bunnings. Whilst the Bunnings lease is only 3.6 years, we do believe that we've got a very high probability of extending this tenant back out to the long-term basis which we target for this fund. Over the last 30 years, Charter Hall has had a lot of success. And this success isn't just because of the strong returns we've been able to provide to our investors over the long term, or the partnerships we've been able to forge with our tenant customers. The ESG side is also something that will continue to drive returns over the long term. So ESG simply stands for Environment, Social and Governance. What this slide shows up on the screen is a lot of detail around the focus of Charter Hall across all three measures. We've got the #1 largest Green Star footprint in Australia. We've got highly rated energy efficient buildings with either 5-star or 6-star ratings. We're generating over 12.5 megawatts of solar capacity from our industrial and logistics portfolio. On the social side, we're Australia's #1 property company with the employer of choice for gender equality. We have what's called Pledge 1%, where we will donate a combination of 1% of our time, our profit, and our space that the buildings operate in. On the governance side, all our responsible entity boards have both an independent chairperson as well as a majority independent directors. We're a signatory to the Modern Slavery Statement, as well as being operating COVID-safe return to work initiatives, as you would expect with a major property company like Charter Hall. Thank you for joining us today. If you'd like more information on any of the opportunities currently open to investment, you can visit our Advisor Resource Centre at charterhall.com.au/advisor centre, or please do contact one of our team. Once again, I want to thank you all for contributing to the success that Charter Hall has been able to deliver for our investors and advisor customers over the last 30 years.